On today's episode, we are going to take a look at Palantir. This company just reported earnings, and it's been a wild ride for investors today alone. Pre-market, the stock was down over 10%, and right now, while I am recording the video, the stock is actually green. It's been a crazy ride. In today's episode, we're going to take a look at the earnings. I'm going to share my overall thoughts on what I like and what I don't like. If this is your first time here, make sure to hit the subscribe button. Don't forget to hit the thumbs up, and stay tuned where I live stream here on YouTube, taking a look at stocks you want me to look at. So let's get started. So today we're going to take a look at Palantir. This is a quick chart of how the stock was at 8 o'clock before the market opened. It was down about 10% pre-market. But if we take a look at the stock prices right now, the stock is sitting at $19.26 and it's actually up 4.2%. So it's been a crazy ride. Congratulations to any investors that purchased at the bottom today. But if we take a look at the higher scheme of things, from the 52-week high, the stock is still down 50%, right? It's been a crazy pullback in the long term of things. This is traded under the New York Stock Exchange as ticker PLTR, and it has a market cap of about $36 billion. And like I mentioned, they just reported earnings, and that's the whole reason the stock is up right now. But before we begin, let's take a listen to today's sponsor. I want to thank the Motley for sponsoring this video. The Motley is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. Alright, so now let's take a quick look at their overall earnings. Again, it's just going to be a nice overview of their earnings. I definitely recommend checking out the presentation. They have a lot of great information, but their main highlights are they saw 49% year-over-year growth on revenue. This revenue growth was not only stronger than what they previously guided for. They previously guided for 45%. They saw 49%. It's actually stronger than what analysts expected. So the company was also profitable on adjusted operating incomes, and it now has a margin of about 34% compared to a loss same time last year. And what I want to say is probably my favorite things is this company is now positive in operating cash flow from operations and positive in free cash flow, where now free cash flow, and this is adjusted free cash flow, represents 44% of adjusted margins compared to a loss same time last year. So the company reported $341 million in revenue. And for those that are not familiar with Palantir, they have 2 main businesses. They have the government and they have the commercial. The government makes up a good portion of that total revenue. That's about 208 million out of that 341, and so I want to say close to 60% of the revenue comes from total government. That was up 76% compared to the same time last year. That's super amazing. Most of it coming from United States government customers. That was up 83%. The other segment, their total commercial revenue, was also up big. This was $133 million, and this was up 19% compared to the same time last year, right? Double digits, in my opinion, is still strong growth. 72% growth from United States commercial customers. Like I mentioned, the presentation was pretty cool. They shared some of business updates of some new commercial companies using their Foundry platform. For example, we can see an electric vehicle takeoff and landing company right now that is now using their Foundry. We also see another industrial and manufacturing and exoskeleton is also using Foundry. And they also talk that they continue to invest deeply in Western innovation like semiconductors, EV vehicles, and genomics as a whole. Not only are they increasing their revenues and new customers, but also the revenue per customer is increasing compared to the same time last year. In the trailing 12 months, there has been a revenue increase of 29%. Now, every trailing 12 months, on average, it's about $8.1 million per customer, whereas last year was about $6.3 million. The average revenue per top 20 customers is also increasing 34%, where now the top 20 customers on average paid about $36.1 million on trailing 12 months revenue compared to $27 million. So these strong growth, it says that, hey, the companies that not only are they getting new customers, but the customers they have are using and paying for more of their services. That's definitely a great bullish sign. All right, so the company also gave us guidance for the next quarter, for the next year, and for multiple years ahead. And I think that's pretty strong. I also believe there's some things here that might have some bearish or bear people kind of excited. I'm going to talk about them. First, if we take a look at quarter two, they expect revenue of 360 million, which represents a 43% growth. Remember, this quarter was 341 million. So not only are they seeing strong growth year to year, but they're also still seeing growth quarter to quarter. Next, they reported adjusted operating margins of 23%. And I want to say this might be a little bearish sign, or what the bears are looking. I don't really think it's a bearish sign, but I could see other bears looking at it because margins this quarter were actually 34%. So you're going to go from 34% this quarter to 23% next quarter. So something to keep an eye out. Let's also keep in mind though that the guidance that they had for this quarter was 23%. So there were some movements of some customers this quarter that actually ended up helping operating margins go up to 34%, but the prior guidance was 23%, and for next quarter they still expect that 23% as well. Next, let's take a look at the full year for 2021. They are adjusting their free cash flow guidance from break even to an excess of $150 million. Let's take a quick look. Right now, free cash flow, this adjusted free cash flow this quarter was about $150 million. Let me just pull up that chart real quick so we can take a quick look. Yeah, adjusted free cash flow was $151 million this quarter. So now they're saying for quarter two to quarter four, they don't expect them to be positive in free cash flow margins anymore, or if they are, it's going to be net even. And I want to say these guidance that the company is giving right now, especially for the full year, might be a bit conservative in my opinion. I do believe if things work better for quarter two, we might see another guidance improvement for the upcoming year. That could be a very bullish sign to investors. Finally, for the long term of things, this company expects revenue growth of 30% for this year and the next 4 years. So this is a hyper growth stock. Next, a quick look at the balance sheet. The company has plenty of cash, about $2.4 billion of cash and cash equivalents, and they have about $200 million of debt. So not leveraged at all. The other only thing I want to mention is this company has increased its total stock-based compensation. That has made its expenses a little bit higher. Obviously, this is not cash expense, but increased stock-based compensation is still some form of dilution in shares. So that's it for today's episode on Palantir. Like I said, it's super simple. The company did report strong earnings. I am happy that they are positive in cash flow from operations, that they are positive in free cash flow. They're still expected to grow at crazy levels, and customers are growing not only in numbers of customers, but the amount of revenue each customer is bringing. If I was to play Palantir right now, how would I do it? I don't have it in my portfolio, but right now, it's down 50% from its all-time highs. Times like now would be the time where I would add a little bit bigger than small position, somewhere like a medium-sized position, and add up over time. Just because, growth stocks are still taking a hit, and like we saw, pre-market this stock was giving us 10% down. So there could be buying opportunities, but at the same time, those buying opportunities may never come. So sometimes it might be good to just get some skin in the game. Palantir is not one I hold, and I have no intentions of buying right now. If this is your first time here, like I said, make sure to hit the thumbs up. Take care and see you next time.